Good afternoon, everyone, and welcome to today's webinar, Pinnacle Partners Mid-Year Update. My name is Jeff Feinstein, Managing Partner, Pinnacle Partners. I will be hosting today's event. We have an exciting list of topics to cover today, and I'll be joined by this esteemed panel I will introduce in just a moment. But before we get into the details, I must show the disclaimer. And I want to acknowledge that clearly this has been an uncertain time for all of us, economically speaking. More recently, we've seen bank failures, rising interest rates and inflation, stock market volatility. And this has all been very challenging for all of us participating in the real estate market. Pinnacle Partners has demonstrated resilience and adaptability, and we've been exploring opportunities during this market dislocation. And in today's presentation, I think you'll find that we've been quite ingenious, looking to optimize returns on behalf of our investors. And we are pleased to announce a very strategic partnership with Trilogy Investment Company. Joining us today is the CEO of Trilogy Investment, Jason Joseph. He'll be speaking to us later in the presentation about Trilogy at large and their participation in the build-to-rent market. We're quite excited to be partnering and investing in build-to-rent product. So today, we'll be obviously make an introduction. Many of you know Pinnacle Partners, but we'll review Pinnacle Partners. The Opportunity Zone benefits still very much in place. The IRS's largest tax credit program ever. And then into the specifics of our Pinnacle Fund VIII, the curated portfolio of 5 projects now. We'll get into detail and disposition each of the projects, including 2 new BTR projects with our sponsor Trilogy. And then Jason will take us through BTR as an overview. This is a burgeoning product type, and I think you'll be excited to learn more about. So just at a glance, the vital stats for Pinnacle. We are top ranked by Novogradac as one of the upper quartile OZ real estate fund managers. We now have 14 projects that we control and in the process of capitalizing. That represents close to, well, more than $250 million of aggregated capital gains invested in these projects. And in total, close to $1 billion of project costs that we're supporting and sponsoring and investing in. And this is largely to deliver much needed multifamily in these highly attractive targeted markets that we've pursued. So we were an early mover. This is the only thing we do each and every day is source high quality projects, provide oversight to the projects we're invested in, nurturing the partnerships that we have with our sponsors such as Trilogy. I think it's important to, once again, many of you know, but once again, remind people of the tax benefits provided by the Opportunity Zone legislation. There's, I think, some misnomers from time to time. The program's expired. It's no longer attractive. That is not true. Still very much in force through 2046. Already has attracted north of $100 billion of capital gains, a proven economic stimulant program. In fact, there's bipartisan legislation to extend this program further, and we'll speak to that in just a moment. But again, as a primer, if you invest a capital gain, short or long term, within 180 days of realization into an Opportunity Zone project such as Pinnacle Fund VIII, you will then immediately qualify for tax deferral. So you will not be obligated to pay the tax associated with that capital gain transaction until April 15th of 2027. So benefit number 1 is effectively an interest-free loan on that tax otherwise due through April 15th of 27. The second, and we think the most profound benefit, the most compelling compounding wealth benefit is tax elimination on the appreciation in the Opportunity Zone real estate investment. So after a 10-year holding period, you qualify for tax exemption and you pay no tax on the appreciation of the underlying real estate asset. That's an incredible advantage, and to our knowledge, no other tax credit program provides tax elimination as the Opportunity Zone legislation provides. And then the third benefit, and the numbering is a bit off, so apologies, is the use of depreciation. So real estate investments are generally tax efficient, and you get to offset income with depreciation. But in a non-OZ transaction, you're required to recapture depreciation at terminal sale. In the case of Opportunity Zone investing with the 100% step up in basis at terminal sale, there is no recapture of depreciation. So you get effectively tax-free cash flows in Opportunity Zone investments with the use of depreciation. Also, a bit of a misnomer. Some people think it's just stocks or just real estate transactions that qualify. And the answer is anything that the IRS deems as a realized capital gain is eligible for OZ tax benefits. We list several here. Partnership interests have been particularly interesting of late, real estate sales as well. Carried interest earned by private equity, venture capitalists, and hedge fund participants generally is characterized as short-term. And so they would be deferring, or anyone investing a short-term capital gain would be deferring at the higher 39% rate. So the OZ program, still very much active. I think that OZ capital is flowing when institutional capital is sidelined. The benefits we think are extraordinary compared to an after-tax investment. And there's the potential of extending these benefits further to move the deferral out to 2029, to add back a discount or step up in basis on the deferred tax. So we stay tuned for the 108th Congress, their ability to get past debt ceiling, and then move on to economic impact programs like the Opportunity Zone. So as we experience stock market volatilities, the traditional 60-40 stock and bond portfolio just has proven not to be so resilient under current market conditions. We think real assets is where you want to be, otherwise called alternative real assets, and especially tax-efficient alternatives like Opportunity Zone real estate. The benefits are numerous. So we just spoke of the reduction in tax burden. So real estate generally is tax efficient. Add OZ real estate, and we think that's tax efficiency on steroids. Second benefit, again, excuse the numbering, is portfolio diversification. So you can, strike an uncorrelated position, uncorrelated from the stock market, that is, with real assets, and in particular real estate, which is less volatile on a day-to-day, week-to-week basis. Multifamily real estate has been a classical hedge against inflation. So you can mark to market your rents each and every year. So you have the opportunity to get the property value to appreciate and rental income to increase with inflation. We spoke earlier about income and the use of depreciation, where you can, in Opportunity Zone projects and multifamily projects in particular, you can enjoy durable cash flows because we're generating net operating income using depreciation to offset tax implications and deliver to our investors cash on cash returns after stabilization. And then lastly, tax-free appreciation. As discussed earlier, after the 10-year hold, you get to qualify for tax elimination, zero tax. If an investment went from $1, now valued at $4, the $3 in appreciation now is tax exempt, no tax on that appreciation. So we think there's very compelling benefits to investing in real estate, more specifically Opportunity Zone real estate, and within the category of real estate, multifamily, which is what we have chosen to exclusively focus on and build this curated portfolio represented in Pinnacle Fund 8. So I will now bring our panel forward and my partners at Pinnacle Partners, Leo Backer and Jill Holman, to discuss and provide a real-time update on Pinnacle Fund 8. Leo?
Thank you, Jeff. And again, welcome everybody. We are extremely excited to present to you today our completion of our Fund of Five, as Jeff mentioned. And we launched Pinnacle a little over almost a year and a half ago, Pinnacle Fund 8, after funding 10 single asset projects. And some of you may know this, but we started Pinnacle by investing one project at a time as single asset raises. And we decided to launch Pinnacle Fund 8, bringing Jill Homan on as a partner, who we're extremely happy and lucky to have on board, when we were hearing from a lot of our investors and wealth advisory firms that they really wanted a multi-asset fund option to look at. They liked our approach and our underwriting and the projects we brought as single assets, but they really wanted a more curated fund, diversified around the country. All of our single asset projects have been in Washington and California, and a lot of our investors, again, in RIAs, were asking for a portfolio really outside of the West Coast to diversify their holdings. And that's where we came into Jill. Jill and I have been talking for over 3 years now about how to work on projects together, and we thought this was a perfect way to launch. And we also thought multifamily was the best product type to bring into this fund because, as Jeff mentioned, in these uncertain times, especially, we really feel like multifamily is the safest investment choice. And for us, we see multifamily as a mix of market rate housing, workforce housing, student housing, and even senior housing. And now we'll hear from Jason, the build to rent product, which we're extremely excited about. So you see on this map, these were the locations that we really kind of focused on. And the first thing we did is we built an advisory board for Pinnacle to really assist Jeff, Jill, and I, and Blake on really strategically, what market should we be focused in? And once we focus in on these markets, they are really helpful on us, advising us both on our underwriting and also, high level strategy. We're lucky to have Walt Smith with Avenue 5 Residential. They manage over 100,000 units across the country, and they really are helpful with Jill and I in our market analysis for each market. We've got Glenn Appel, who's on the board of several large private and public real estate entities. We've got also AP Hurd, who's a very large developer in the greater Seattle area and on several boards. And then Molly Fadul, who is the CIO and CFO of JPI out of Dallas, one of the largest multifamily developers in the country. And we're extremely helpful for us, again, especially in these challenging times, because Jill and I, we have our certain underwriting criteria that we rely on. And frankly, it was very hard for us to really approve a deal to take to the next step. And it really helped us really digging in with Walt and Molly, especially because they're in the markets every day, both on leasing and also on financing, really to look at, under the hood, how should we be approaching this? And again, we're extremely excited now. You'll see the 5 stars that we now have projects in Denver, Phoenix, Austin, Nashville, and our latest project in Charlotte that we have locked in our joint ventures on. Jill is going to go into a little bit more detail on those projects, but why these locations? So first off, these markets we feel are, extremely positive job growth, even though it's slowed down in probably every market. We feel like these markets are more resilient than others. There's also a huge movement for quality of life in these markets and very positive business climates. You'll hear from Jason on kind of why he selected certain markets for his portfolio, but we believe even though these markets could be high barrier of entry because they're not easy to get through permitting, they still are business friendly environments where companies are looking to relocate. And for us, job growth is really premium. We're really following where jobs are and where people are moving for quality of life. We've also really, in the last 6 months especially, and I would say certainly the last 90 days, have looked really hard in our underwriting and how we negotiate our joint ventures. And Jill will go into a little bit more detail, but I'll just say high level, the only good news, or some of the good news that's coming out of this market today, is when we launched Pinnacle 16, 18 months ago, it was very hard to compete for these projects with other OZ funds and other, capital chasing the same deals. Today, people are calling us and basically equity has leverage, and Jason will probably chime in a little bit, but we've been able to get extremely favorable terms with our sponsors. Our preferred return is gone up. We're really protecting downside risk. And Jill can talk a little bit more about that on how we negotiate our waterfalls, our development fees, et cetera. And it's extremely important for us to be aligned with our sponsors. These are 10-year holds. So for us, the process is Jill and I will, and we've looked at Jill probably over 100 projects at least, but to get to the funnel of due diligence, maybe that's hit 30 to 40. And when it's gotten to our advisory committee, maybe that's a dozen, right? So there's a huge rigor of review for each of these projects. And the other thing I want to add is, Jeff talked about opportunity zone benefits, and that's really kind of where we stop the real estate conversation, because we like people to know that Jill and I don't underwrite these projects with the OZ benefits. We're looking at pre-tax returns. They have to stand on their own. And we always start, Jill always likes to say, what's the story? Why does this developer like this location? Why are they, interested in this product type in this location? Because it really has to resonate for us and meet the market, even if it is an opportunity zone benefit. So you'll hear from Jason that, what we've done, basically have gone to some developers and say, we like your market. We want this product type. They look at their portfolio of land that they may have under control. And then they say, this happens to be an opportunity zone. And we love that story because they would have moved forward even if it wasn't. So again, we're very excited to have our fund of 5 with 5 very strong sponsors. Well, 4 sponsors, because Trilogy has 2. We've got Mortensen Construction in Denver that you'll hear a bit more about with Jill. We've got Trilogy in Phoenix and Charlotte. We've got Stonehawk out of Dallas is our Austin developer, and Stillwater Capital, also out of Dallas, is our Nashville developer. 5 very strong developers. And again, not only do we need alignment with our sponsors, but in today's banking environment, we also have to make sure they've got balance sheets and relationships with lenders today, because it's extremely hard to get construction loans in this climate. So with that, Jill, I think it'll let you kind of go into a little bit more detail on each project.
Great. Thanks, Leo. So our first project that we'll talk about is our Denver multifamily project. Our development partner there is Mortensen. There's Mortensen Development and Mortensen Construction. They're a vertically integrated national development and construction company with significant resources. This project sits at the Platte River Trail system. So you'll see in the first picture the water and like the shrubbery, but that's hiding a little bit of the trails. So you can literally walk out the front door and beyond this trail system that goes to all parts of Denver and also to downtown. So it's a fantastic location. It's across a parking lot from the Denver Stadium. And those parking lots are really controlled by the stadium district and will be master planned in the near future. The site also is about 2 miles to downtown, as I mentioned, either driving or you can use the river trail. And so there's about 150,000 jobs downtown. And it's less than a mile to 3 university campuses and 43,000 students. And so it's really actually an easy walk to the universities. It sits between 2 transit stations. So we mentioned one here, less than a half a mile. So it's really walkable to the transit station, connecting downtown and then to all parts in Denver. Our project here is 200 units. When we initially looked at the project, Mortensen had designed this as being really studios in ones. And so with the long-term hold, we were concerned about functional obsolescence. And so we came in and asked that they program some 2 bedrooms, which they obliged. And so we're pleased with really where our unit mix landed. The construction, we've closed on the construction loan and at the end of the year, and Our start is imminent, as in it's a matter of, a week or two. So it's really weeks away. And our delivery, construction delivery is projected in 2024. So we'll go on, and we're actually in the midst of selecting our property management company to gear up for our pre-leasing, and then we've recently started to brand the asset. So we're in a lot of fun activities with putting shovels in the ground and also with getting the word out about the asset. Our Nashville East Bank project, interestingly, is also right near their stadium. You may have read about the new Titan Stadium. So that will be proximate to the new Titan Stadium, and it kind of sits in between the new Titan Stadium and the new Oracle campus that's about 65 acres. And I think there's some renderings there with the new Titan Stadium. And just when you think they couldn't make a stadium nicer, they figure out a way to add more glass and make it nicer. So it would be really nice. And so it dramatically changes this neighborhood as well. We thought the site was exciting with the existing stadium, but then you put in billions and billions of dollars of investment with private capital and also public capital, then it's a very exciting project. Similarly, this project sits at the foot of the river, the Cumberland River. So we have waterfront views, and then we also have fantastic views into downtown CBD because we're directly opposite of the central business district. As with Denver, Nashville continues to see significant population growth. And that's driven really in large part from the job growth in both cities. And then we are expecting our approvals and construction to commence early next year. So we'll go to the next project. There we go. Okay, so Austin, McKinney Falls. So this is a project in Southeast Austin. And so, what I would say with the first two projects, you have some form of structured parking, podium and it's a form of parking. And so this is a very different product type sitting in Southeast Austin. So this is surface parked. We'll have some garages, of course, for rent, but this is sitting in Southeast Austin, proximate to the airport. So the airport's been expanding tremendously, and then also proximate to the Oracle and Tesla's newish facilities there. Austin continues to rank in the top markets for rental growth, and we continue to see that in this market as well. And then this is about the ingress and egress is terrific, and it's just a couple miles from the Interstate 35 and one of the major thoroughfares. And then I would say this feels a bit more suburban than the others truly feel urban, and they're more of an infill site. And so this is really, just a short drive away to do all your shopping and entertainment venues. And then, everything is pretty close, 10 or 15 minutes to be at these major job employers. So we're expecting our approvals and construction start to be early next year. And so to rewind, I forgot to mention that the Nashville project, Stillwater is our development partner, and Stonehawk on the Austin project are our development projects. And both, as Leo mentioned, are very experienced development firms. And that's one of our gating criteria, particularly now, is we want firms who have, to really be building another one of those, meaning firms that have built and have a significant track record in building what they're proposing to build, because, we need to ensure that our projects are financed and that they move forward and that they're successful. And one of the clear criteria with that is ensuring that you have a well-experienced development partner. And so we have with this project is very interesting. It's in Avondale. which is right outside of Phoenix. And this is an infill site for a master plan, a small master plan community. And this is 107 build to rent single family rental community. And so this is a project that we partnered with Trilogy on, and Trilogy is the development partner here. So this is also an infill site, and it's walkable to retail amenities. And then we, for example, we toured the comps and just couldn't get over how high the rents were for the build to rent project. And so we are underwriting to what is currently in place rents, and we're excited about the growth in this Avondale market. And in particular, a lot of folks hear about Phoenix and hear about the growth of Phoenix, but interestingly, it's just Avondale is, and I'm sure Jason can speak to this a little bit, but is a little bit of an anomaly in that greater Phoenix market, and that it's harder to get projects approved, which makes some barriers to entry. And so we're right through the thick of that and expect to come out the other end and start our horizontal construction. So start with our site work towards the end of the year. We'll go to the next project. So Charlotte, so this is a project, and so first, this is a project that's located in the Noda neighborhood. And so this is a really fast growing neighborhood in Charlotte, and with a lot of housing, commercial, retail amenities. And it's also it's walking distance to the Sugar Creek light rail station. And there's just a significant amount of, there's a number of major projects that are also in pre-development that are more on the multifamily and retail side. And then the Charlotte, as you may know, is a major banking hub with headquarters of Bank of America and Wells Fargo, second only to New York City. And then Charlotte's experienced significant growth, just as the other cities that we're investing in that this is the sixth fastest growing metropolitan area, having added about 200,000 residents over the last 5 years. And this project is actually, we're acquiring a brand new townhome rental community, 68 units as the townhomes are built. And so Pulte is constructing the townhome, and then our partner Trilogy and Pinnacle are acquiring the townhomes. And so interestingly enough, there's really two strategies for employing the opportunities and tax incentive. One strategy is really development, and the second one is buying new construction. And that has to do with one is either substantial improvement, or the other one, or it's called second strategy is called original use, which is bringing new tangible property into an opportunity zone. So if that doesn't make any sense, just know that the two strategies that folks can use with opportunity zones is either development or buying new right before the certificate of occupancy is issued. We like this project a lot. We think we're buying at or below replacement costs. And this is a project, as we mentioned, that we think is well situated as Noda and as Charlotte continues to grow. And we think we're meeting a market where a lot of, and this can lead into what Jason's going to talk about, which is a lot of first-time home buyers or home buyers are wanting to pause on buying a home or not able to find a home, which makes them a renter. And so we're able to provide high-quality rental product, purpose-built rental community for them in a well-located area. And so with that, just want to make one other quick point and then lead into Jason. And that is, as Leo touched on, during this time, we've really seen a transition being from a lot of capital competing for projects and the developers driving all of the terms to it really being a negotiation or the investors having more say in the terms. And so with that, we've been able to, we think, provide for some great opportunities for investors in the form of promote share for some projects. Another project, for example, the developer, when we first started talking with them, had made a case for for all the work that they had done to put their land in at a higher basis. And, as we negotiated, we were able to bring that down to the developer putting in their land essentially at cost. And we've also been able to share in some of the development fee, which all of that, when I say we, I mean Pinnacle Fund 8. And so all of that goes to the investors and everyone's benefit. And so what we're really trying to do is to be mindful and thoughtful as we underwrite, and to think about where interest rates are and where they're going, where cap rates are and where they're going. But also, I would just say, with a long-term hold, what we're really focused on are, high quality locations, high quality projects, and high quality development partners. And we think if we get that mix right, we'll be able to weather any sort of short-term volatility in the market to come out the other end with great returns and also with a strong project. So teeing off from our Charlotte project, as I mentioned, Jason is the CEO of Trilogy Residences, and we can go to the next slide.
Yeah, and before doing so, if I may interject and suggest that we're accepting Q&A, and we'll move to a Q&A session upon Jason's presentation concludes. And if I may, I would just like to get this poll out. Let's see, I'm going to launch it now, just testing to see if our attendees are interested in allocating towards real estate as a form of diversification, offsetting correlation to the stock market, and or maybe have an actionable gain before them and seeking to invest in an opportunity zone. Jill and Leo, thank you for really describing all the good work we've been doing during this more volatile period, which has frankly been to our advantage in building one of the most attractive curated portfolios available in the OZ market. And we did announce formally a partnership with Trilogy Investment Company now about a month or two ago. It's a programmatic partnership. It has led to the two projects that we just reviewed. And we wanted to ask the CEO of Trilogy to be our guest today to talk about the emerging market, the build to rent market. Let's talk about the investment thesis, the arbitrage opportunity that you saw, Jason, and then a little bit more about Trilogy, please.
Sure, that's great. And I always kind of start off with I haven't been on a webinar before, Jeff, Jill, and Leo, where all of the advantages of capital today, pulling from the benefit from who used to control the deals, the developer. And I will say this to everyone, it has been an absolute pleasure, and it's my pleasure to be on this webinar today, not only to talk about Trilogy, but most importantly, the partnership with Pinnacle, and what they have exemplified through the last almost year that we've gotten to know one another, with getting our first deal underway in Avondale, and now most recently in Charlotte. And it is truly about not only having institutional quality underwriting, operations, back office, et cetera. And as they talk about curating, the number of deals that I know they've seen just from us, and the way that this particular fund has curated. And it's just an honor to be a part of such a great group of developers, ones that we've looked up to, ones that I've known in the past, and an opportunity to be a part of this has just been absolutely fantastic. And what's given us the opportunity here is that we have shifted exclusively into build to rent as a burgeoning asset class, one that is likened to multifamily. And so as you look at the way, as we'll talk through, the capital markets have viewed build to rent over the last couple of years, what we have seen is very similar to what happened in 90 to 92 when this crazy condo for rent, because of all of the supply that sat out there during that crisis, where someone ultimately began saying, why don't we rent them? And ultimately you see over the course of the last 25, 30 years, that asset class has turned into what we call multifamily. And while we're sitting today as this curated portfolio that's now in development, that is in this Pinnacle Fund 8, and now build to rent, when you look at sort of the pivot and why Trilogy Investment Company was created, was truly looking at what was happening in the markets in 16, 17, 18, where you started to see not only where capital was flowing to residential. I was developing at the time hotels, office, retail, multifamily, et cetera. and saw this social and thematic shift happening with rising costs of homes, where we saw interest rates ultimately not necessarily as high as they are today, but we ultimately saw that they couldn't sustain where they were at historic lows over the course of a decade. And what we found is that we literally titled in April 2021, Trilogy was there to redefine the American dream. And as you redefine what's home ownership, what happened was this evolution of two sort of groupings of people, a third that evolved through the interest rate debacle that we've seen, but ultimately this millennial class and this quote unquote 55 plus, this baby boomer class, where ultimately there was a choice that was happening. And what was important to us was making sure that at our core, we were developer first. We wanted to, Blake, you mind backing up real quick to that first slide before you jump? Thanks, buddy. And what was important here is that we saw this opportunity within not only the social and sort of thematic cultural things that were happening across the US, but ultimately we wanted to make sure that we were able to create a positive impact for the residents that ultimately who were no longer buying but choosing to rent. How could we create a multifamily-like lifestyle, maintenance-free lifestyle that gave us the ability of creating neighborhoods that as you drive by look nothing short of a for sale neighborhood, but gave the maintenance-free lifestyle and choices for those that either needed to rent or ultimately wanted to rent. And for that, we are a faith-based company. It's super important for us. We are based in Alpharetta, just north of Atlanta, Georgia, in a suburb of Atlanta. And over the course of just a short 2 years, we were able to assemble very quickly north of 2,500 home lots across 7 states, grew this organization as an institutional developer and sponsor to where, as we were interviewed by Pinnacle, it gave us an opportunity to stand next to the institutional sponsors they were able to select. And it was absolutely important for us, where we were originally a Southeast focused developer that then expanded across through relationship, through employees, through staff, through partnerships, got us into the Southwest markets where we saw the most opportunity as we go. So go ahead and flip to the next one, Blake. What is important here is our investment strategy was originally solely focused on BTR development. And through site selection, through an acquisition process that ultimately the Pinnacle team had the opportunity to walk through with us, we sat along high growth small state primary and secondary markets, and obviously both infill and path of growth neighborhoods. But what was equally as important is that we were, because BTR was a new asset class, effectively 95% of the market was new construction. So you had to have a vertically integrated site selection team, planning and zoning, get us to permit, construction management, project management, asset management, capital markets, an A to Z approach to this, so that we knew that we were going to be identifying through both quantitative and qualitative process, our ability to identify the best sites. What is important here, though, is that the demographic within that particular site ultimately defined the product type that we were going to build, whether that was townhome, whether that was bungalow, whether that was a duplex, whether that was a single family detached product. Ultimately, the demographic and what we call the renter persona, the renter profile, gives us the ability of defining what that home, what that resident needs in that particular market. And what was interesting with the BTR development aspect of it is that over the course of the last year, the forward purchases became an opportunity for us to leverage the home builder market dislocation, i.e., there was a machine across every one of the home builders, from Lennar at the top to the local to the regional home builder, that had these machines of producing homes, where now all of a sudden those homes that were going to be built or had been built could not be sold to the retail buyer because of rising interest rates and ultimately this price dislocation that occurred. And it gave us an opportunity, which is where you see the Charlotte, what we call North Davidson NODA project, where we saw that as an opportunity with Pulte to leverage it in this, to where we were able to remove the construction risk of the project and put that back on the builder while being able to maximize returns and ultimately maintaining compliance within the opportunity zone. So it gave us an opportunity at Trilogy across the markets that we're in the 7 states. It gave us the ability of working both on the development side and seizing the opportunity, which we think is a window, not necessarily long-term, but a window to partner with that builder and continue to buy those homes in purpose-built communities that we'll talk about in a second. Go ahead, Blake. So you'll see here very quickly, anything that you see across, we now own, as I said, just north of 2,500 home lots with close to 600 under construction today. We have, as you can see, some expansion plans across that are under contract that's now approaching close to 5,000 in both primary. And as you look at the dots on the screen, you'll see towns like Myrtle Beach, Charleston, Augusta, but you'll see major markets like Austin, Texas, like Atlanta, Georgia, like Phoenix. And what we found interesting about Pinnacle was that as they layered into Austin, we were in Austin. As they layered into the other areas that you see up here, like Phoenix, like Austin, like Atlanta, these are areas that they wanted to be in or that they were in that gave us an opportunity to marry up like-minded strategy. Go ahead, Blake. And so for not knowing where people sit on the spectrum of what in the world is build to rent, we thought it would be a great opportunity to dispel some misnomers and also bring sort of a consistent viewpoint of an introduction to build to rent. And I'll really just highlight a couple different things in that you'll hear build to rent properties or liken them to BTR communities. And you'll also hear that you'll hear the term SFR, single family rentals. During 2008, 9, and 10, during the GFC, the great financial crisis, when you had an onslaught of supply relative to scattered either homes within existing neighborhoods or individual home sites across your communities, and everyone has seen them. The single family rental scattered site portfolios began burgeoning, and that asset class began taking hold. Part two to that is build to rent. And what is the differentiator here is it is a professionally managed, self-contained residential community with a single owner. It is not a scattered site. So these are purpose-built communities of single family homes, townhome, and as you'll see here in the product groupings that we call them, where you have two-story townhomes, single level row homes, you have traditional single family, you have luxury single family, and then what you'll see in the top right are your traditional horizontal multifamily, and those are single family detached. And you'll see that all of this mix, regardless of the product type, are in self-contained, professionally managed, purpose-built communities. Love words, and I'll just sort of add here, we break this up here where the strategy of build to rent comes around targeted for rent assets, targeted markets, our target demographic, and then ultimately that, as you round the horn, so to speak, ultimately generates predictable returns, not unlike traditional multifamily. And so as you roll through targeted for rent assets where you're looking at detached SFR, townhomes, and what's interesting now, what's similar to the NODA project in Charlotte, this was originally a for sale community that we have converted to a for rent purpose-built community. And so when you look at the dislocation of the markets and you see that rental market remaining tight, where we have a limited supply of rentals in the market, you'll see here that the opportunity, think about 5% of the SFR rental market is institutional, which means we have a tremendous opportunity of increasing that allocation that gives us the maximum opportunity to benefit from these targeted returns that we believe are so sustainable. So we've shifted into high growth suburban markets around central cities. Obviously, these high growth suburban markets with relatively low cost of living and strong job growth. You'll see ones that we're in today: Atlanta, Phoenix, Austin, Denver, and Seattle. We are expanding into other southeastern regions between Nashville, Tampa, Orlando, as you can see. And it is important to know that there's a lot of folks that are moving into secondary and tertiary markets. A lot of employers, when you take Charleston, our friends in Seattle, right, Pinnacle with Boeing. Boeing has a very large, their Southeast headquarters is actually in Charleston. And so when you look at the supply chain and you look at the things that are burgeoning there, when you look just north of there in Myrtle Beach, when you see what's happening in Conyers as a suburb of Atlanta, all of these different secondary and tertiary markets have their own set of stories, and it's maintaining consistency in that investment thesis. And lo and behold, as you round to the left at our target demographic, these are the two where traditionally you'd look at first-time home buyers, that now that millennial, quote unquote, between 24 to 39, what we have found is that not only are they first-time home buyers that may have been priced out of the market due to what's happening, but what's interesting about their, what we'll call social theme, is the choice to rent, the flexibility of being able to pick up and leave for a new job, to be able to pick up and leave and move somewhere where now we're seeing a lot of at-home working, as we've known with the office asset class, what's happening there. It's given us this ability of being able to offer at-home private backyards, fenced-in backyards, common amenity, maintenance-free lifestyle-like apartment, but now giving them the optionality of being able to rent rather than buy. And to that point, the baby boomers have become a major source for us on the rental demand. And this is across the spectrum in every market, where we're beginning to see in Florida, in South Carolina, in some of these more coastal areas as well, up to including nice weather in Arizona, specifically Texas, what have you. We're starting to see an unbelievable onslaught of baby boomers that are moving into the choice to rent, being able to liquidate their homes at these prices and being able to go on fixed income. And that rental opportunity gives them the ability of having choice. We like to break this down into 5 critical items for the case for build to rent. And this is where we'll sort of conclude the overview, which is we have a housing shortage in the United States, and this is a fact. Our incoming supply relative to the continued shortage, this statistic was at the end of last year. The newest statistic at the end of Q3 is now approaching 6.3 million homes. And now what's happening is, as folks are moving into other areas, and the inability with the capital markets to deliver mortgages where people can continue to absorb the supply that's being built, that shortage continues, and which leads to the affordability crisis. Now think through this: 400 basis point swing on a 30-year mortgage rate has translated into a 60% increase in monthly payments. So for us, we can deliver an equivalent home with equivalent finishes for a monthly payment that is now less than if they were to purchase, and what also includes a maintenance-free lifestyle. So when you look at that affordability crisis, what is important is not to make light of. You have a shortage of housing shortage that ultimately has created an affordability crisis, that now we have a shifting demographics between millennials and the baby boomers, which now has created this BTR market opportunity at bullet 4 here. And that particular bullet is an interesting statistic. With 16 million SFR, single-family rental units nationwide, only 60,000 homes have actually been purpose-built as rentals by the end of 2021. That's only 5.3% of the total. So as the market has grown, last statistic I'll leave you with, the market has grown that when the interest rates moved 400 basis points over the course of a 9-month period, there were 26 million home buyers that were pre-qualified to purchase that would have equated to a $400,000 mortgage that got priced out of the market. That particular supply or called of renters or of home buyers has now given us a third avenue of folks that now have been pushed into renting because they no longer can buy. To that point, the home builders obviously, and this is the last point on our forward purchase strategy, with the impact of rising rates, home builders have been faced with balancing their market pricing. It's given us an opportunity to step in to work with those builders and forward purchasing their inventory to create purpose-built neighborhoods for the original home buyer that was going to be there, and giving them now an option to rent. And for that, these 5, what we'll call bullet points, have really created an unbelievable opportunity for us to seize an alternative multifamily asset class into the burgeoning build to rent market. And we're super excited to have all of you as an opportunity to invest in Pinnacle and alongside our partnership with them. Thank you.
Thank you, Jason. Fantastic. Really do appreciate it. Excellent. Well, we're moving to the conclusion of the webinar. Please, again, raise your questions in the Q&A button if you wish. I think what we've tried to deliver in today's presentation is acknowledgement of the uncertain times, our adaptability in constructing a portfolio of just 5 very high quality opportunity zone multifamily products and projects. And as you now through the BTR explanation understand, we can participate in this burgeoning market in the case of no to obviate the development risk. And really, we look to deliver exceptional returns to our investors over time as we renegotiate our agreements and specific terms with sponsors, take full advantage of the patient capital that we are by definition, opportunity zone investors seeking to hold for 10 years, weathering the cycle and delivering institutional quality product that ultimately will be attractive to institutional investors, that is pension fund, life insurance companies at terminal sale. So that is the synthesis of today's agenda. We've got some questions. Let me just
Hey, Jeff, as you look for that, I just would like to summarize real quick before we go to Q&A of, Jason, thank you so much. I think, that was very, informative for sure. And I learn more every time I hear you speak about stats and why we're so excited about BTR. But I just want to wrap a bow around, again, this fund to five. I think as Jill, really went through eloquently, starting with build to rent. I think you probably heard from Jason why we got excited about adding this product type to our portfolio. We think it de-risks the fund. Having one forward purchase project like at NODA will provide cash flow sooner, which is very important to us and to our investors. So two, build to rent projects, one a forward purchase, one garden style project. Today we're only looking at garden style and built to rent. We don't think podium construction in today's market, to us, the risk is worth the reward. But then the Denver under construction, great construction loan terms already in place, and Nashville right in the middle of this burgeoning entertainment district and right next to downtown. We think we've assembled the best portfolio of five that we've seen of any other fund out there. So again, Jason, thanks so much. And let's go to Q&A.
I see. Oh, go ahead. Did you want to, Jeff, go through the Q&A?
Yeah, we got a question here. The build to rent renter persona, Jason, is that individual or likely a family? Are they more likely to pay premium? Number one, because it's an amenitized community, maybe closer to schools and services. Two, duration of leases. So just a commentary as when compared to multifamily, kind of classical renter statistics or metrics.
Sure. Short answer is to the first answer or the first question regarding premium to rent. So across the build to rent marketplace, you are traditionally seeing, and I'm going to say this, it all is market specific, but that renter persona is developed in market and will traditionally pay anywhere between 5, literally to as much as 20% rent premium over the course of, on a per square foot basis, knowing that there's a chunk rent limit to that relative to the wage, that's being done in that market, Jeff. So great question there. But typically you have your rental payment, and then you have what's called an HOA and or an amenity fee to where that maintenance lifestyle where internet, trash, pest control, lawn maintenance, et cetera, is a tack-on fee that ultimately ends up both covering cost on the property in order to perform those services, but likely creates a small additional arbitrage relative to cost. Second question to that, and Jeff, did I answer that properly?
Yeah, that's good. Yep.
Great. And you mind repeating your second question?
But just duration, are they
right
for 12 months, 24 months?
Yeah, average multifamily
less than
average multifamily lease. Great question. Average multifamily lease historically is 1.2 years, and build for rent has proven just a shade under 3 years to as much as 3.1 years. And so that obviously means that the stickiness of the tenant, the credit profile of the tenant, generally speaking, means you've got less repairs and maintenance, less turn costs, and overall property maintenance ultimately is less because that weighted average lease term is longer.
Excellent, thank you. Jill and Leo, we discussed kind of I call it optimizing terms. You could use another term like retrade on terms on existing projects that we have control of and potentially already pre-existing JV agreements. So can either one of you speak to the types of terms we've renegotiated during, again, the changing market conditions?
Jill, go ahead.
So
Jill,
of our deals, Denver, Nashville, Austin, Charlotte, and Phoenix, the only deal that we did not renegotiate with improved terms was Denver. And that was because, we had closed the construction loan and that was really baked. But, we're always trying to just advocate for our investors and our position. And so it's something that even when the project starts, we continue to advocate for our position. But with the other projects, Nashville, Austin, Charlotte, and Phoenix, we all were able to improve the terms, which was really, I would just say, it's just a function of where the market is and needing to try to protect more downside and reduce some costs.
So all sponsors are seeking construction financing. The loan to cost ratios have shifted downward considerably, and therefore there's the need for more equity. And I think somebody said, maybe Leo or Jason or both, that equity now has leverage, and that's been applied to our portfolio. Another question here, really comparing, maybe Jill, you want to take this. Obviously, you can go get treasury yields at 4 and change, or you can invest in an opportunity zone project. Do you have any thoughts on the benefits of investing in real assets with a longer term higher rate of return?
So I think, Jeff, we debate this because this gets me a bit fired up. I would say, when one talks about, hey, I can get, buy a 3-month treasury and get 5%, or I can buy, why would I invest in your opportunity zone fund to get a 10%? And I think it's a couple of things. I think there's a conflating of it's the definition of IRR. And so it's easier to get a higher IRR in a short term, but that you can't spend IRR. And so just because you get 3 months, over 3 months, you get a 5% return doesn't yield much money at all. And so these are longer term holds, which having a 10 IRR and a long term hold, it produces a lot more money. And so I would really compare apples and apples when we're looking at these types of returns. And so that's something that I would just be mindful of. And so what I would also say is that in order to get equivalent return, on a 10-year hold, it's just tremendously difficult. And so the benefit of investing in, real estate, and particularly the Pinnacle Fund VIII, is also that you're investing in real assets versus in an equity or something else. And so I think as we talked about during this time of volatility, investing in real assets is very compelling. And that's also why people revert to gold and other commodities. And so I would just caution folks just at looking at IRR. We also would like to talk about equity multiple. And so we're targeting north of a 2x equity multiple on our hold as well. And so again, when looking and comparing different alternatives for investing, look not just at the IRR, but also at the equity multiple, and look at the risk adjusted return as well.
Thank you, Jill. And full disclosure, Jill has a big short on treasuries right now. We have a final question here, Jason. You talked about, I call it the ARB, the arbitrage, the limited window that exists that presents the BTR opportunity, whereby Pulte and others are kind of selling to shore up their balance sheet, selling partial communities, by the way, and obviously full communities. How long do you think that window lasts? Are you seeing direct correlation with interest rates?
Sure.
Up or down? Can you give us some context there?
What's really interesting with the question is that there's actually two drivers that are actually evolving in this. And the first one is the immediate, which happens to be what we'll call inventory, and that inventory opportunity of being able, like with Pulte, it was a certainty of close. If you really think about it, on the 68 unit North Davidson, to answer the question, it's almost like buying 68 retail sales, right? And from their perspective, we're buying it at or below replacement cost on a fixed price, which is the equivalent of a development deal, except we're not assuming that construction risk. So for us in the mindset, they're looking at it as maintaining the engine and getting those unit sales. And I do think that part two to that is that, yes, Jeff, as interest rates are where they are and continue to price out, as costs continue to come down, there's going to be an inflection point where as costs come down and builders begin to readjust their pricing while maintaining margin as it relates to that interest rate, that yes, home sales will continue, or excuse me, will then pick back up. We think we said back in fourth quarter of last year that it was a 6 to 9 month window. Now we think that window is growing. We think that window is 12 to 18 months. But what is also interesting is that a number of the regional to local builders, the ones that are more entrepreneurial, are literally now seeing that build to rent is an asset class that's here for good, and it will continue to grow across the US for decades to come, similar to multifamily in 90 to 92, or condo for rent into multifamily, which means a number of the builders are telling us that they're forecasting 10%, 15%, 20% of their 100% sale goals, let's call it, for the year. They believe that partnering with build to rent developers will create another line of business and opportunity for them to continue to sell forward to us. For us, it's like a fee development or fee build proposal. To them, it's continuing that unit sales to help create a certainty of close for a portion of their assets. So specifically for NODA and a deal like that, we think it's going to be another 12 to 18 month window, and we'll see where it goes from there.
Okay, thank you. A reminder, the Opportunity Zone legislation has designated 8,700 zones across the US. Each and every state is participating. So obviously we've done, I think, a fantastic job sourcing high quality projects in several urban locations, and build to rent just opens the aperture as we continue to look for BTR in the OZ, which is why we've created this programmatic partnership with Trilogy that is represented in Pinnacle Fund 8 and in future funds. I think that's it. We're at the hour. I'd like to thank everyone for participating. Very good questions. We'll continue to take questions. We will deliver a recording of this presentation. We're happy to deliver the presentation itself for those that request it. And we really do appreciate your time and attention. Thank you for joining us.
Thanks, everybody.